In the fast-paced world of digital assets where fortunes can shift in a matter of hours, today we confront a stark reality that has many investors on edge. Bitcoin, the undisputed leader of the cryptocurrency market, appears to be fighting for its survival amid mounting pressures, while altcoins are experiencing a brutal crash that has wiped out significant value across the board. Is this the bottom before a massive reversal, or are we staring at deeper challenges ahead? Welcome to CryptoHub, your trusted source for professional insights into the evolving cryptocurrency landscape. As we dive into this critical market update, we will examine the current dynamics, historical parallels, technical indicators, macroeconomic influences, and potential pathways forward with the seriousness this moment demands. The cryptocurrency market has always been characterized by its volatility, but the events unfolding in late May 2026 have tested even the most seasoned participants. Bitcoin is currently trading in the vicinity of $73,000 to $74,000, a level that reflects a substantial pullback from its all-time high above $126,000 reached in October of the previous year. This decline of nearly 40% from its peak has left many questioning whether the flagship asset can maintain its dominance or if structural weaknesses are beginning to surface. Meanwhile, the broader altcoin sector has suffered even more acutely, with many tokens down double digits in recent weeks and the total crypto market capitalization hovering around $2.5 trillion after shedding trillions in value earlier in the year. These developments are not occurring in isolation, but are intertwined with global economic uncertainties, regulatory shifts, and shifts in investor sentiment that require careful analysis. To understand the gravity of Bitcoin's current struggle, it is essential to look back at the broader context of the post-halving cycle. The 2024 halving event had initially fueled optimism, driving Bitcoin toward new highs as supply issuance slowed and institutional interest surged through spot exchange-traded funds. However, by early 2026, a confluence of factors began to erode that momentum. Geopolitical tensions, including trade tariffs and conflicts affecting energy and commodity flows, prompted a risk-off environment where investors fled to safer assets. Bitcoin, once seen as a hedge against traditional finance, found itself correlated more closely with technology stocks and broader equity markets during this period of deleveraging. Reports of significant ETF outflows, exceeding $2.5 billion in May alone, have exacerbated the selling pressure as institutional players reassess their positions amid persistent inflation concerns and potential interest rate adjustments by central banks. Altcoins, which often thrive on speculative fervor and Bitcoin's strength, have been hit particularly hard in this environment. Tokens across various sectors, from decentralized finance to non-fungible assets and Layer 2 solutions, have seen their values evaporate as liquidity dries up and traders rotate back into Bitcoin for relative safety. Bitcoin dominance has climbed above 59%, signaling a clear preference for the king of crypto during uncertain times. This shift has left projects with weaker fundamentals or excessive hype struggling to survive, with many smaller altcoins down 50% or more from their recent peaks. The crash is reminiscent of previous bear phases where euphoria gave way to capitulation, but the scale this time is amplified by higher leverage in the system and more mature institutional participation that demands greater scrutiny. Delving deeper into the technical picture, Bitcoin has been consolidating within a critical range between $72,000 and $75,000. Support levels around $72,000 have held so far, but repeated tests have raised concerns about a potential breakdown if selling intensifies. Resistance sits firmly near $74,000 to $77,000, where any breakout attempt has been met with strong supply. Chart patterns suggest a possible accumulation phase forming, with on-chain metrics showing large holders accumulating rather than distributing, which could indicate underlying confidence despite the surface-level turmoil. Moving averages, such as the 200-day indicator, are providing dynamic support, but the relative strength index has dipped into oversold territory multiple times, hinting at exhaustion among sellers. For altcoins, the picture is bleaker, with many trading below key moving averages and showing breakdown patterns that could lead to further downside before stabilization. Macroeconomic headwinds cannot be overstated in this analysis. Global trade policies, including tariffs that have disrupted supply chains and fueled inflationary pressures, have created an environment where risk assets like cryptocurrencies are viewed with caution. Central banks, particularly the Federal Reserve, face difficult choices between combating inflation and supporting growth, leading to delayed rate cuts that keep borrowing costs elevated. This impacts leverage positions in crypto, where liquidations have cascaded through the market, amplifying moves in both directions. In February and subsequent months of 2026, billions in positions were wiped out in single sessions, underscoring the fragility introduced by high leverage. Furthermore, the correlation between Bitcoin and traditional markets has increased, meaning crypto no longer moves independently but reacts sharply to developments in stocks, bonds, and commodities. Yet, amid these challenges, there are glimmers of potential for a massive reversal. Historical cycles demonstrate that cryptocurrency markets often experience prolonged periods of consolidation or correction following major bull runs, only to emerge stronger. The 4-year halving cycle, which has guided previous bull markets, suggests that while 2026 may represent a bear leg or accumulation phase, the groundwork for recovery could be laid in the latter half of the year or into 2027. On-chain data reveals shrinking Bitcoin supply on exchanges as whales and long-term holders accumulate, reducing available sell pressure. Institutional interest remains intact, with several major firms continuing to view Bitcoin as a strategic reserve asset despite short-term volatility. Regulatory developments, including clearer frameworks in various jurisdictions, are also providing a more stable foundation for growth compared to earlier, unregulated eras. Considering the role of Bitcoin specifically, its narrative as digital gold continues to hold appeal for many. In an era of fiat currency debasement and geopolitical instability, Bitcoin's fixed supply of 21 million coins offers a compelling store of value proposition. However, its recent underperformance relative to expectations has prompted soul-searching within the community. Is Bitcoin evolving into a more mature asset class that experiences smaller but more frequent drawdowns, or does it still carry the explosive potential seen in prior cycles? Analysts point to metrics like the stock-to-flow model, which, despite criticisms, has historically provided rough guidance on long-term valuation. Current models project potential upside to $80,000 or even $100,000 if key resistances are cleared and macroeconomic conditions improve. For altcoins, the path to recovery is more complex. Many projects have delivered technological advancements in scalability, privacy, and decentralized applications. Yet market sentiment has overshadowed these fundamentals. Ethereum, as the second largest cryptocurrency, has faced its own pressures, but maintains a strong ecosystem through staking and Layer 2 innovations. Solana and other high-throughput chains continue to attract developers, while sectors like artificial intelligence, integrated tokens, and real-world asset tokenization offer unique value propositions that could drive independent rallies once Bitcoin stabilizes. The key will be a rotation out of Bitcoin dominance, which historically precedes altcoin seasons. If dominance rolls over from current levels around 59 to 60%, capital could flow into alts with renewed vigor. Investor psychology plays a crucial role in these market movements. Fear and greed indices have swung heavily toward fear, creating opportunities for contrarian thinkers who recognize that capitulation often marks local bottoms. Social media and news cycles amplify both optimism and despair, but professional analysis requires looking beyond headlines to verifiable data. Wallet activity shows that retail investors have been net sellers in recent months, while smart money has been positioning for the long term. This divergence is a classic signal in market cycles, suggesting that the current pain may be the precursor to a significant upswing. Educational initiatives and improved infrastructure are also helping the space mature, reducing the likelihood of total collapse but not eliminating short-term risks. Examining specific risk factors more closely, exchange-traded fund flows remain a pivotal indicator. After initial enthusiasm drove inflows in 2024 and 2025, the reversal to outflows has weighed on prices. However, this may represent a healthy reset rather than a permanent exodus, as institutions recalibrate based on risk management protocols. Geopolitical events, such as tensions in key regions affecting energy prices, indirectly influence mining profitability and network security. Bitcoin's hash rate has remained resilient, indicating that miners are holding firm or even expanding operations in anticipation of better times. Security of the network is paramount, and any perceived threats could further influence sentiment. On the regulatory front, progress toward clearer guidelines in major economies could act as a catalyst for reversal. While uncertainty persists, signs of constructive dialogue between industry leaders and policymakers suggest that outright bans are unlikely, paving the way for integration into traditional finance. Stablecoin adoption continues to grow, providing essential liquidity bridges and underscoring the utility of blockchain technology beyond pure speculation. These developments provide a counterbalance to the bearish narratives dominating current discussions. Looking ahead, several scenarios emerge for the coming months. In a base case, Bitcoin holds the $70,000 support zone, consolidates, and gradually climbs toward $80,000 as summer progresses, potentially sparking selective altcoin recoveries. A more bullish outcome involves a swift break above 77,000, fueled by positive macroeconomic data, or ETF inflow resumption, leading to a broader market rally. Conversely, a bearish breakdown below 70,000 could test lower supports around 65,000 or even lower, though such a move would likely exhaust sellers and set up a stronger rebound. Altcoins would follow suit, with stronger projects bottoming earlier than weaker ones. Risk management remains essential, with diversification, position sizing, and a long-term horizon being key principles for navigating this environment. The importance of on-chain analytics cannot be understated in this assessment. Metrics such as realized price, coin days destroyed, and exchange reserves offer insights that price action alone cannot provide. Currently, these indicators lean toward accumulation rather than panic selling at scale, supporting the thesis of an impending reversal. Developer activity across major protocols remains robust, with upgrades and new partnerships announced regularly despite price weakness. This underlying innovation ensures that when sentiment turns, the infrastructure will be ready to support higher valuations. Community resilience has been tested before and has proven strong, with many using downturns to build rather than abandon projects. Furthermore, the global adoption narrative continues to unfold. Countries exploring Bitcoin as a reserve asset, corporations adding it to balance sheets, and increasing everyday use cases for blockchain technology all contribute to a foundation that transcends short-term price movements. In emerging markets, cryptocurrencies provide financial inclusion where traditional banking falls short, creating organic demand that can stabilize the market during Western sell-offs. This diversification of user base reduces reliance on any single region's economic health. As we synthesize these elements, it becomes clear that while Bitcoin is indeed fighting for survival in the near term, and altcoins are bearing the brunt of the crash, the setup for a massive reversal is plausible if not probable. The market has matured significantly since previous cycles, with better tools for analysis, stronger institutions, and technological progress that was unimaginable years ago. Investors who approach this with discipline, focusing on fundamentals over fear, are better positioned to benefit from the eventual upturn. Patience and thorough research will distinguish those who thrive from those who falter. The coming weeks and months will be telling. Key levels to watch include Bitcoin's ability to reclaim $75,000 decisively, and any shifts in dominance that could ignite altcoin momentum. External catalysts such as Federal Reserve decisions, inflation reports, or breakthroughs in major protocols could accelerate changes. In the meantime, staying informed through reliable sources and maintaining a balanced perspective is vital. CryptoHub remains committed to delivering these professional updates to empower our audience with knowledge that cuts through the noise. In conclusion, the cryptocurrency market stands at a crossroads where challenges abound, but opportunities for those with vision persist. Bitcoin's battle and the altcoin downturn test resolve, yet the potential for reversal underscores the dynamic nature of this asset class. Thank you for joining us on CryptoHub, where we continue to provide serious, in-depth analysis to help navigate these turbulent yet promising waters. Stay vigilant, invest wisely, and we look forward to updating you on the next developments in this ever-evolving space.